Hey, welcome back everyone. It is time for another red hot covered call video. Hey look, today we're going to talk about that deep in the money covered call I just wrote last week. Yes, we just talked about it, how I made that nice 2% deep in the money covered call. Well, the stock has rocketed since, and if you've been watching my videos, you know I don't sit on my hands. I look to use exit strategies so I can make even more money. And today I'm going to show you exactly how I did that. But before I get going, look at that. 100,000 views for my channel. I cannot believe I have told you the very genuine story that when I started doing my videos, if I had 1 or 2 cats hitting the like button, man, that would have made my day. But now I have 1,500 subscribers. I'm probably getting about 50 subscribers every couple weeks, and this is just ramping up to where my email inbox is packed with questions and success stories. I love it, and I am absolutely blessed, and I am absolutely thankful for your support. That's why we do this. Let's keep the learning going. Now, hey, look, if you like what we're doing here at the channel, I want you to subscribe to the channel. You see that button right there? More importantly, if you like this video, man, bang that like button, guys. It lets me know you like what I'm doing. Just last week, I finished up a series on the deep in the money covered call. Like I said, this is one of the most frequently asked questions. When you're starting to learn this strategy, you look at those deep, juicy premiums. If you don't know anything about options, you might think it's a heck of a trade. Then you find out you didn't make much money. Why? Because remember, an option has real money and time value. And that time value is our profit. So if there's not much time value, we don't make much profit. So it's very important that when we run our numbers through our spreadsheet and we're calculating profitability, we understand that. The deep in the money covered call is great for downside protection and locking in those gains. But it's not good if you think the stock's gonna rocket. Why? We lose all the upside potential. Yes, that's why the out of the money covered call is typically talked about, where you could buy the stock, you can then write the out of the money covered call, pick up the premium, you calculate both profitability to get your total profitability. So when somebody says they make 3% on an out of the money strike, they are talking about the premium they get for the covered call right and the stock appreciation. That's the most common covered call people write. But the deep in the money covered call is one that you might write if you think the stock's going to go down or you want to lock in those gains and have your shares taken away. I put together a playlist on my channel right here. I put 4 of my favorite videos in this playlist. I want you to go there and watch them. If you're confused about the deep in the money covered call, I explain it straight talk style. And when you watch those, I guarantee you're going to understand the deep in the money covered call. Hey, look, let's talk about that Alibaba trade and how it turned out. Now, guys, Alibaba has rocketed since I bought it. If you remember, I bought it here at 184x. And I wrote that 175 deep in the money covered call. I got $13. $10 was real money. $3 was time value. That $3 was my profit. Since then, Alibaba has rocketed higher. And look at it, guys. It is now trading at about 206. Well, I've missed all that upside. And I have 20 days left on this contract. So I am sitting there with my 2% gain. At the time, I was content with, but now with Alibaba rocketing, I need to see if I can make even more money. Now, we're going to talk about that trade right now. So the setup is simple. It's really 3 simple parts here. If I'm going to buy the shares, then I'm going to buy the shares back, then I'm going to look for another covered call to see if I can make even more money, I have to break this down. So the very first part was simple. I did this last week. I bought Alibaba shares. I bought 200 shares, paid 184x. I wrote the 175 deep in the money covered call. I got paid 13 bucks. You could see the profitability there for 28 days. Well, with Alibaba rocketing higher, now I find myself with 20 days left and Alibaba is moving 20 points higher. Can I make even more money? Well, I'm going to have to use an exit strategy, and that starts with buying back the option. But I also need to see if I'm going to be profitable with this. I put this in part 2 of my calculator. Notice the current stock price at the time of this is 202. And the premium that I got paid 13x is now trading for 28x. I'm going to have to pay $28, alleviate my obligation. Then, after I do that, my cost basis is now going to be higher. See how I paid 184x originally? If I buy this option back for $28, my new cost basis is 199x. We need to understand when we buy back options, we are adding to our cost basis, which means we have to take action. Now, that action could be buying back the option, writing the next covered call. And that's what I'm going to do here. Now, instead of writing the deep in the money covered call, I'm going to write the out of the money covered call. And as you could see, when we buy the option back, increasing our cost basis to 199x, now if I write the 210 Alibaba February 16th, I get $5.10. That turns out to be a 7.9% gain. So for me, I'm going to take the risk of buying this back and then writing the out of the money covered call. And I did, and I got pocketed that money. Now it's a waiting game till February 16th. But here's the deal. We have risk. What is that risk? Well, we have earnings, and that's coming very soon. I'm going to wade through this because I think Alibaba's going to go higher. But let's talk about that risk. I definitely don't want to present this as if there's no risk. There is, anytime you buy back an option and add your cost basis. I'm going to ask you right now to pause the video and think about the risks. Now, these are the risks that I see. 1, I'm adding to my cost basis. 2, I'm writing an out of the money covered call. Remember, that's pie in the sky percentage projections. There's an earnings coming. So there is moderate risk. I say moderate because it's February 1st. My option is February 16th. I might be able to avoid some of that volatility. But here's the deal. There is risk because Alibaba will fall or gain 20 points. So it is a volatile play. And we have minimal downside protection. Remember with the deep in the money covered call, when I wrote that deep in the money covered call and got paid $13, well, $10 of that was downside protection. As the stock would fall 1 for 1, as the stock would fall 1 point, the option would fall 1 point. And if it fell 2 points, the option would fall at least 2 points. That's true downside protection on a deep in the money covered call. But when you're writing out of the money covered calls, that option that I got paid $5 for is not going to fall 1 for 1. Why? Because there's no real money in it. It's all time value. And that time value will not fall 1 for 1. Yes, it provides downside protection to some extent, but not 1 for 1. Hey, look, if you can think of any other risks, I want you to put them in the comments. I want to learn from you cats. Hey, look, here is that trade. I'm going to finish this up real quick. I went ahead and I made that trade. Here's the buyback. Remember, I want you to notice something. Over to the left, action, buy to close. A lot of people know that we sell, sell, sell. Sell to open. I can't say that enough because when you are approved for your options trading, you're presented with a lot of options. And some people buy to open. That would be a mistake. We don't write covered calls by clicking buy to open. We sell to open. But you do click buy to close when you want to buy back an option. So in this case, it's buy to close. Notice I select a limit order. In this case, I picked the mid. See, right there in the middle of the screen? And I got filled. So now I have assumed the risk of adding to my cost basis. I need to make that trade. I have to have a plan, and I need to execute the plan. What did I do? I already had it queued up, ready for my out of the money covered call. There it is right there. I sell to open, 2 contracts, February 16th. Notice the 210 strike, it's a call, and notice I did the limit order, $5.10. So I want to highlight the square box at the bottom. See how it says bid and ask with 40 on each? See, that's your open interest. There's 40 orders sitting there in limit orders ready to be bought and sold. A lot of people confuse that with the volume. The volume is not your open interest. It's very important to have at least 100 open interest limit orders waiting because you want to have people sitting there willing to buy your options if you want to sell them back. I told the story of Whirlpool where I sold that juicy covered call and there was literally one person out there to buy that option. And then when I tried to get out, there was nobody there. So I was stuck, and sure enough, I had my shares taken away. So you want to understand the importance of open interest. Hey, in this case, I ended up making some money. Hey, look, if you're not using spreadsheets, this is a numbers game. It's very important that you have your spreadsheets, and I offer them for free. There's no hooks. Now look, before I let you go, there is my website, free spreadsheets. I want you to go there. I want you to look at the spreadsheets, pick the one that's right for you, download it for free. Again, there's no hooks, and I have how to use videos. Remember, I created these spreadsheets for my game, so I could keep the numbers in front of me. Hey, look, I hope you enjoyed this video. I hope you learned something. The important thing to understand is that we're not boxed in. We're not boxed in. If we make that trade, the stock rockets higher. We're not sitting there feeling like we're holding the bag and having that fear of missing out. Look, at the end of the day, plug the numbers into the spreadsheet, and if it's profitable, do it. Have a plan, execute the plan. That's what I do. I hope you enjoyed this video. I'd love you to bang that like button. And hey, until next time, I hope all your covered calls are profitable.
All I see is signs.